$10,000 sitting in a savings account at 0.5% yields $50 after a year. Saving feels responsible, yet saving alone rarely builds real wealth. There is a bright line between two jobs. Savings protect money, investments grow money. The numbers demonstrate the gap. Place $10,000 in a typical savings account at 1%, and after 1 year, the balance is $10,100. Put the same 10,000 into a vehicle that historically matched the S&P 500 at about 10% per year, and the first year lands at $11,000. Compounding over time widens that difference dramatically. At 1% for 20 years, 10,000 grows to about $12,200. At 10% for the same 20 years, 10,000 becomes about $67,000. The biggest wealth gap is not between savers and spenders. It is between people who save and people who invest. Many never cross that line. The barrier is not math, it is psychology. Cash in a savings account sits still, investments move. They can drop 5% on a random Tuesday afternoon. That volatility feels risky, so people freeze. Here is a staged plan that protects stability while unlocking growth. Step 1. Build a real emergency fund. Before investing a single dollar, accumulate 3 to 6 months of living expenses in cash. This money stays in savings. It is reserved for job loss, medical emergencies, and car repairs. Investors often panic sell because they need cash too soon. An emergency fund shields investments from the shocks of ordinary life. Step 2. Separate saving from investing mentally. Create 2 buckets. Bucket 1 is safety money. Bucket 2 is growth money. Safety money does not move. Growth money is allowed to fluctuate because its job is long-term growth. This mental separation reduces anxiety dramatically. Step 3. Start investing small. Many platforms let a person begin with $50 or $100. The goal is not massive profits. The goal is build a habit. Habits matter more than timing. Step 4. Focus on simple investments first. Beginners often jump into day trading, options, or crypto speculation. The simplest investments often outperform the complicated ones. Index funds track the overall stock market. Instead of picking winners, an investor owns hundreds of companies at once. That brings diversification, lower risk, and long-term growth. Warren Buffett has repeatedly recommended low-cost index funds for most investors. Now quantify the power of consistency. Invest $300 per month. If the market averages 8% per year, after 25 years, the account reaches roughly $285,000. Only $90,000 came from contributions. Almost $195,000 came from investment growth. That is compounding at work. Markets fall, headlines turn dramatic, people panic. Discipline separates investors from gamblers. Saving is like storing seeds in a jar. They are protected, but nothing grows. Investing is like planting those seeds in soil. It looks messy at first, and over time, growth appears larger than the original seeds. What if the market crashes? Crashes are normal. They have happened dozens of times.
Long-term investors benefit from downturns. When prices fall, monthly contributions buy more shares at lower prices.
That leads to stronger returns when markets recover. Think in decades, not days. First, build a 3 to 6 month emergency fund. Second, separate money into safety and growth. Third, start small and invest consistently. Fourth, favor simple long-term vehicles like index funds. Fifth, stay disciplined and give compounding time to work. Saving gives stability. Investing gives freedom. Combine both early and the financial future becomes more powerful. And don't forget to like and subscribe to keep on learning.